Let me ask you a question. What do Boeing, Volkswagen, and Wells Fargo all have in common? And don't worry, this isn't the setup to a bad joke. You might be stumped in trying to figure out the answer because it doesn't really have anything to do with the type of products that each of these companies sell. Pause the video and have a think about it if you want to. The thing that each of these companies have in common is that they've each been involved in some of the biggest corporate scandals of the past decade. Boeing 737 MAX 8 jets were responsible for one of the worst aviation disasters in recent memory, resulting in back-to-back crashes. Volkswagen were involved in one of the most high-profile environmental scandals of all time, and were found to be intentionally falsifying the carbon emissions results of their vehicles. And Wells Fargo were involved in a fake bank account scandal, which resulted in many of the bank's customers being exploited without their knowledge. In each case, both the company and its management were guilty of profit-focused behavior, which embodied a profit at any cost mentality. Now I know what you're thinking. Malone, the whole point of a business in the first place is to be profitable. So what if the companies were focused on profits? Well, yes, you are correct in saying that the business of business is business at the end of the day. But look, it's not the 1900s anymore, and it's well recognized that companies have additional responsibilities outside of maximizing profitability for shareholders. Companies nowadays have many different stakeholders. A stakeholder is effectively anyone who has an interest in the company or who is or can be affected by the company's business. This would include the likes of the company's shareholders, employees, customers, suppliers, and more. So because companies affect so many people in many different ways, there needs to be a way to make sure that both the company and its management team are kept in check. And by kept in check, I mean that they're acting not only in the interests of profitability, but also in the interests of the greater good of society. You may have heard reference to the strength of the management team when researching what separates good companies and bad companies. And one of the key contributors to a strong management team, and by proxy a strong company, is a rock solid foundation of what is known as corporate governance. And that's exactly what we're going to talk about today. How's it going, everyone? My name is Dan, but you can call me Malone. And today we're taking a look at what exactly makes a company a good company. And that question is honestly very important, because at the end of the day, we're all consumers of goods and services produced and provided by companies from all around the world. So it's in each of our best interests that these companies are acting in an ethical way, which benefits not only the company and its shareholders, but also society as a whole. And from the perspective of an investor, you're always going to be better off investing in companies that are conscious of more performance factors than just profitability. And it's ultimately going to be the corporate governance of the company that will determine whether or not the company is in good overall standing. So what I'm going to do is as follows. First, I'm going to explain what exactly corporate governance is and why it's so important for companies to have rock solid corporate governance. Second, I'm going to give you an example of what bad corporate governance looks like and how this can lead to the downfall of many companies. And finally, I'll conclude by giving you some tips on what you should look out for when looking at the corporate governance of a particular company. But before we begin, as always, if I could ask you to please leave a like on the video. Liking the video really does help me out a lot, as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And the more people who watch this video, the more people there will be who will be ready to call out companies for bad behavior. And that's what we like to see. And if you are new around here, please do consider hitting that red subscribe button below and hitting the bell for video notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So what exactly is corporate governance? Corporate governance is effectively the system which dictates how companies are directed and controlled. Just like how different sports have different rule sets which set out how the game should be played, or how schools have different rules about what behavior is or isn't tolerated, companies also have rules which set out how the company should be ran. Companies, for the most part, generally have the ability to set these rules themselves. However, the best of the best will be aiming to have their companies be compliant with corporate governance codes, which are effectively a set of standards created by independent third parties. These codes are said to be the gold standard when it comes to corporate governance, and companies which fully abide with the codes are held in high regard. One such code is the 2018 UK Corporate Governance Code, which was released by the Financial Reporting Council, aka FRC. On the FRC's website, they describe the code as placing greater emphasis on relationships between companies, shareholders, and stakeholders. directors. The code promotes the importance of establishing a corporate culture that is aligned with both the company purpose and business strategy, while also promoting integrity and valuing diversity. Okay, so there's a lot of points in there that are very important. Corporate culture is more or less the attitude of the company towards its business, and this encapsulates everything from the production process of its products to its interaction with customers to the attitude of its employees. The corporate culture of a company will be heavily influenced by the tone at the top, which is a term used to describe the ethical atmosphere, so to speak, set by the company's leadership. If the leadership team of the company are not promoting ethical behavior from the top down, then it's highly likely that unethical behavior and unethical practices will end up materializing. So what the code encourages companies to do is to match up its internal corporate culture, which is effectively what will determine how the company does business, with both the company's purpose, i.e. the value that it wishes to create, and also its business strategy, i.e. how that value will be created. Therefore, companies which have a corporate culture which promotes integrity, ethical behavior and inclusivity while also being profitable in doing so will be considered to have very strong corporate governance. The code is in no way saying that it's a crime to care about profitability, but rather it's holding companies accountable to the actions that they take in achieving that profitability. The UK Corporate Governance Code in particular focuses on the appointment of a diverse, qualified and value-driven board of directors who focus not only on the profitability of the company but also on the best interests of all of the company's stakeholders. Furthermore, the code also provides standards when it comes to the company's systems of internal control, risk management systems, and internal audit functions, all of which contribute to the overall integrity of the company. So if you're an investor looking to put some of your hard-earned cash into a company, you can take some degree of solace if the company has the compliance stamp with the code. That's because you know management are actively seeking to achieve the absolute gold standard when it comes to corporate governance. So having discussed corporate governance and its importance, you may be wondering what bad corporate governance looks like and the impact that it can have not only on the company itself but on all of the company's stakeholders. Let's take for example the Boeing scandal. The events which led to the crashes of both Lion Air Flight 610 and Ethiopian Airlines Flight 302 in 2018 and 2019 respectively started when Boeing's biggest competitor Airbus announced that it will be making significant upgrades to its most popular jet, the Airbus A320. Airbus were planning on making the A320 more fuel efficient, which would save the airlines lots of money. This was cause for concern for Boeing, as Airbus's new model could steer some of its airline customers away from the company. So Boeing announced a new model design for their existing Boeing 737 jet, the Boeing 737 MAX. However, what Boeing didn't mention to the airlines which bought the plane was that they had installed software into the new model which was effectively a workaround solution to issues that they had identified during the production process of the jet. To make matters worse, Boeing advertised the 737 MAX as being virtually identical to its predecessor planes, meaning that pilots received little or no training on the new jets, nor were they made aware of the new software. So when the instruments which the software relied on malfunctioned, there was virtually nothing that the pilots could do to save the planes. This scandal is a direct result of bad corporate governance. Boeing's leadership were so adamant in staying competitive with Airbus and protecting profitability that they were willing to get the 737 MAX into the hands of airlines no matter what, i.e. profit at any cost. The cost in this case was 346 human lives and a financial cost of nearly $19 billion to Boeing. Some of the employee emails which surfaced in the aftermath of the scandal highlighted a toxic corporate culture which was clearly profit focused. For example, one employee stated, "I still haven't been forgiven by God for the covering up I did last year," while another stated that the 737 MAX is designed by clowns and supervised by monkeys. Had Boeing focused more on its corporate governance and aligning its corporate culture with both its purpose and its strategies while also preserving integrity, this disaster could have been avoided. So what is the best way that you as an investor in the stock market can figure out whether or not the company that you're looking at has good corporate governance? Well, the best thing that you can do is to go to the annual report of the company and look up their corporate governance statement. In this example, I have the annual report of Ryanair, and as you can see, Ryanair have a full section dedicated to their corporate governance report. This will tell you the detail behind the principles by which the company does business. Another tip I would have is to scan the news which has been reported about the company over the past year. While you shouldn't rely on any mainstream news in making any determinations about the company's corporate governance, it can be useful in just getting a general feel for the corporate climate. But unfortunately, unless you're sitting in the boardroom with the directors, you can never be 100% certain, and so you should always conduct as much due diligence as you see fit in order to become comfortable with purchasing an interest in the company. The important thing to remember is that there's no such thing as good stocks and bad stocks, just good companies and bad companies. And as an investor, you want to make sure you're putting your cash into the good companies. And a good company is one which is not only consistently profitable, but also one which is striving towards a healthy corporate culture, built upon the foundations of a high standard of corporate governance. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.